every single morning, before you drink your first cup of coffee, before you check your phone, before you even open your eyes fully. Somewhere on this planet, a trade worth millions of dollars just settled, and a tiny invisible percentage of that transaction flowed into a system you could be part of right now. You are not a hedge fund manager. You are not a Wall Street insider. You do not need a Bloomberg terminal or a Harvard EMBA. What you need is the understanding that the global financial system is built on layers, and the people who quietly collect from every layer are the ones who never show up on financial news channels. They are the silent partners, and this script is going to show you exactly how that architecture works, why it has created some of the most durable wealth in modern history, and what the practical pathways look like for someone starting from zero with almost nothing but curiosity and discipline. Let me start with something most financial education content never tells you. The loudest people in finance are almost never the richest ones. The traders you see on social media showing off their screens with green candles are retail participants, people trading their own money, taking on personal risk, burning time and emotional energy for returns that statistically underperform a basic index fund over a 10-year period. The quiet ones, the ones who never post, the ones whose names you have to search for because they do not volunteer information, those are the people operating as silent partners inside structures that generate income whether markets go up or down, whether the economy is booming or collapsing, whether anyone is paying attention or not. This is not a conspiracy. This is just how capital architecture actually functions at scale. Here is the foundation. Every financial instrument that exists, every stock, every bond, every futures contract, every option, every currency pair, every commodity, every real estate investment trust, every exchange-traded fund, every private credit arrangement, every structured note, every insurance product, every derivative, every single one of these things exists inside a structure. That structure has layers, and every layer has a fee. The person who designed the structure collects a fee. The person who manages the assets inside the structure collects a fee. The person who distributes the structure to investors collects a fee. The person who provides the legal framework collects a fee. The person who provides the custody service collects a fee. The person who audits the structure collects a fee. None of these people are taking on the market risk that the end investor is taking on. They are getting paid regardless. That is what it means to be a silent partner in a financial structure. Now let us make this extremely concrete, because abstract ideas do not change your financial life. Consider a single exchange-traded fund. Right now, there are over 10,000 exchange-traded funds globally managing somewhere above $10 trillion in combined assets. The average expense ratio, meaning the annual fee charged to investors just for holding the fund, is somewhere between 0.05% and 1%, depending on the category. Let us say 0.2% on average across that $10 trillion base. That is $20 billion per year, flowing automatically, silently, without any of the fund's investors needing to take a single action. The fund managers do not call anyone. They do not send invoices. The fee is embedded in the structure and it collects itself. $20 billion a year automatically from a global base of passive investors who understand they are paying this fee and consider it entirely reasonable for the service provided. Here is what makes this model so powerful and why understanding it can completely change how you think about building wealth. The fee is not tied to performance in most cases. If the fund goes up 20%, the manager collects their fee. If the fund goes down 30%, the manager still collects their fee. If markets are volatile and chaotic and investors are losing sleep, the manager is still collecting their fee. This is the fundamental difference between being a participant in a market and being a toll collector on the road that all participants must use to access that market. The participant takes on all the directional risk. The toll collector does not care which direction anyone is going. They just care that people keep moving through. Let us go deeper into where these toll roads actually exist in the modern financial landscape, because knowing the map is the first step to understanding which roads you could potentially build or invest in. The first category is asset management. This includes mutual funds, hedge funds, private equity funds, venture capital funds, real estate funds, infrastructure funds, and credit funds. Each of these is a structure that collects management fees, typically between 1% and 2% of assets under management per year, plus performance fees on profits. A single successful fund manager running $2 billion at a 2% management fee is collecting $40 million per year in management fees alone before generating a single dollar of investment return. The underlying investments might lose money in any given year, and the manager still receives those $40 million. The second category is financial financial infrastructure. This includes stock exchanges, clearinghouses, payment networks, custodian banks, prime brokers, and data providers. The New York Stock Exchange does not care whether IBM stock goes up or down today. It cares about volume. Every trade that passes through its systems generates a fee. The same applies to DTCC, which clears the overwhelming majority of U.S. securities transactions, processing over $2 quadrillion in annual transactions and collecting fractions of cents on every single one. Visa and MasterCard do not take on credit risk when you swipe your card. They collect a percentage of every transaction that passes through their network. These are infrastructure businesses, and they are among the most consistently profitable structures ever created by human beings. The third category is insurance. Insurance companies collect premiums from millions of policyholders. They invest those premiums in the period between collection and when claims are paid. This invested pool is called the float. Warren Buffett built Berkshire Hathaway largely by understanding that insurance float is essentially free money that can be deployed into long-term investments. The policyholders are funding the investment engine. The insurance company is the silent partner collecting the spread between what it earns on the float and what it eventually pays out in claims. When this model works correctly, the insurance company is getting paid to hold other people's money and invest it. That is a profound structural advantage that took Buffett decades to fully communicate to the public. The fourth category is real estate structures. Real estate investment trusts, private real estate funds, mortgage servicers, title insurance companies, and commercial real estate brokers all sit inside the structure of real estate transactions and collect fees at various layers. A mortgage servicer does not own the underlying property. It does not take on property value risk in most cases. It collects a servicing fee, typically 25 to 50 basis points annually on the outstanding loan balance, just for processing payments, managing escrow accounts, and handling customer service for the loan. There are servicers managing hundreds of billions of dollars in mortgage balances, quietly collecting this fee every month on loans they did not originate and properties they do not own. The fifth category is technology platforms that serve financial markets. This includes financial software companies, trading platforms, portfolio management systems, compliance technology providers, risk management systems, and market data vendors. Bloomberg LP is a private company, which means it does not have to disclose its revenues publicly, but estimates consistently place those revenues above $10 billion per year, almost entirely from subscription fees paid by financial professionals to access its data terminal. Roughly 300,000 terminals worldwide at approximately $24,000 per terminal per year. Bloomberg does not care whether markets are up or down. It cares that financial professionals need real-time data to do their jobs and will pay whatever it costs to access that data. That recurring subscription model, embedded inside the professional infrastructure of finance, is one of the most durable businesses ever constructed. Now let us talk about how someone who is not already wealthy can actually begin to position themselves closer to these structural income streams rather than further away. The first and most accessible pathway is through publicly traded companies that operate these toll road businesses. You can buy shares in Visa, MasterCard, S&P Global, Moody's, CME Group, ICE Intercontinental Exchange, BlackRock, Rowe Price, Brookfield Asset Management, and dozens of other companies that derive their revenues from financial infrastructure and asset management fees rather than from taking on directional market risk. When you own these companies, you are not exactly a silent partner in the same way that the founders were, but you are a fractional owner of businesses that collect structural fees from the entire global financial system. Your returns are tied to the growth of those fee streams, not to whether any individual market goes up or down. The second pathway is through understanding how to build structures yourself at smaller scales. Consider a simple example. Someone who raises capital from a group of investors to purchase rental properties is operating a very basic version of the fee structure model. If they charge a management fee of 1% of assets under management annually and a performance fee on profits, they are operating as a real estate fund manager, even if the total fund is only $2 million rather than $2 billion. The same logic applies to someone who aggregates purchases for small businesses and negotiates better rates, collecting a spread between what they pay and what they charge. Or someone who builds a software tool that automates a financial process and charges a monthly subscription. At each of these scales, the structure is the same. You are designing a system that collects fees from a broader economic activity rather than simply participating in that activity as an individual. The third pathway requires the most patience, but potentially offers the largest long-term advantage. It is the practice of systematically investing in low-cost index funds and holding them for decades. This sounds completely opposite to everything I have been describing about fee collection. And in one sense it is, because when you buy an index fund, you are paying fees rather than collecting them. But here is the deeper logic. By minimizing the fees you pay, by buying the lowest cost index funds available and holding them without trading, you are maximizing the compounding surface area available to you. The person who pays 5% in annual fees on their investment portfolio over 30 years will have roughly 40% less wealth at the end of that period than the person who paid 0.05% annually. The fee difference seems small in any given year. It is enormous over a lifetime. Understanding the structural importance of fees means being ruthless about which fees you pay and building systems to collect fees rather than exclusively paying them. Let us talk about the psychological dimension of this, because knowledge without execution is just entertainment. Most people will read or hear something like this and feel a brief surge of motivation, followed by a return to their existing patterns. The reason this happens is not laziness. It is that the gap between understanding a concept and implementing a new financial behavior feels enormous, and the benefits feel distant. The human brain is wired to prioritize immediate gratification over delayed rewards, and every action required to build structural income streams requires upfront work for delayed benefits. This is why the wealth gap in modern societies tends to compound over time. The people who understand structural income and have the patience to build it grow richer at an accelerating rate. The people who never understand it, or who understand it but cannot act on it, stay on the other side of the fee structure their entire lives. Here is a framework that might make the implementation feel more achievable. Think about your current financial life as having 3 zones. Zone 1 is consumption. This is the money you spend on things that do not generate any future return. Food, entertainment, clothing, vacations. This is necessary and good, and you should not feel guilty about it, but you should know how much of your income is going here. Zone 2 is participation. This is the money you invest in financial markets as a participant, buying assets that may go up or down, taking on directional risk in hopes of building wealth over time. Index funds, individual stocks, bonds, real estate you own directly. Zone 3 is structural income. This is where you are designing or owning systems that collect fees from broader economic activity. Most people have a large Zone 1, a small Zone 2, and almost no Zone 3. The goal over time is to gradually shift resources toward Zones 2 and 3 while keeping Zone 1 appropriately lean. The transition from purely a Zone 2 investor to someone who also participates in Zone 3 does not happen overnight, and it does not require starting a hedge fund. It can begin with something as simple as understanding the business model of the companies you invest in. If you are going to put money into financial markets anyway, why not concentrate more of those investments in companies that are themselves toll collectors rather than companies that are primarily participants in markets? S&P Global, for example, generates revenue by rating bonds and providing financial data. Every time a company issues a bond, S&P Global collects a fee for rating it. There are tens of trillions of dollars in outstanding bonds globally, and more being issued every year. S&P Global does not care whether interest rates are rising or falling. It cares about the volume of bond issuance and the demand for its data products. There is something important to address about risk here, because any honest treatment of this topic has to acknowledge that fee collection businesses are not risk-free. Asset managers face the risk that clients withdraw their assets during downturns, shrinking the fee base. Financial infrastructure companies face regulatory risk and technology disruption risk. Insurance companies can be devastated by catastrophic claims. Real estate servicers face credit risk when loan defaults spike. Even the most structurally advantaged businesses can fail if they are managed poorly or if their competitive moats are eroded by new entrants. The point is not that structural income is magical or risk-free. The point is that the risk profile is different and often more favorable than pure directional market exposure. You are trading one type of risk for another, and understanding that difference is the foundation of sophisticated financial thinking. One of the most important updates to this framework in the current environment is the rise of tokenization and blockchain-based financial infrastructure. Major financial institutions including BlackRock, JP Morgan, Goldman Sachs, and Fidelity have all been building tokenization platforms that allow real-world assets, including real estate, private credit, commodities, and even bonds, to be represented as digital tokens on a blockchain. The reason this matters for the silent partner framework is that tokenization could dramatically lower the cost of building and managing financial structures. If you can tokenize a pool of real estate estate assets and manage it through smart contracts rather than through an expensive administrative infrastructure, the cost of running a fee collection structure drops significantly. This opens the door for smaller operators to build structured fee collection vehicles that were previously only accessible to large institutions. The data economy inside finance is another area that has expanded dramatically in recent years and deserves your attention. Financial data is now being generated at a scale that was unimaginable 2 decades ago. Alternative data providers sell location data, satellite imagery, credit card transaction aggregates, social media sentiment analysis, and hundreds of other data streams to hedge funds and asset managers who use them to gain an edge. The companies collecting and selling this data are not taking on market risk. They are selling information to people who are taking on market risk. They sit above the market rather than inside it. As artificial intelligence tools become more capable of processing and extracting value from large data sets, the companies that own proprietary financial data sets are likely to become increasingly valuable over the coming decade. Let me bring this to a close with something practical and immediate. If you are watching or reading this and you want to begin moving toward the silent partner position rather than exclusively the participant position, here are the specific actions that matter most. First, audit your current fee payments. Look at every financial product you own and calculate the annual fees you are paying. Every basis point you eliminate from your fee burden compounds in your favor over decades. Second, begin studying the business models of companies that operate as financial infrastructure. Read annual reports. Understand how they generate revenue, what their competitive advantages are, and what risks they face. Third, look for small-scale opportunities in your own professional or community environment where you might be able to create a structure that collects fees from broader economic activity. This might be a small fund, a data product, a software subscription, or a referral arrangement. The scale does not matter initially. Learning to think like a structure designer rather than purely a participant is the cognitive shift that matters. Fourth, stay current on tokenization and blockchain-based financial infrastructure, because this is where the architecture of finance is being rebuilt, and the people who understand it earliest will have structural advantages that compound for years. The silent partner position is not a secret. It is a perspective, and once you see it, you cannot unsee it.